I'm Scott Mentzer with Orchard Hill Mortgage, and I want to welcome you to the weekly mortgage update. Okay, so let's jump right in and take a look at last week's mortgage recap. And the average mortgage rates improved significantly last week ahead of the Veterans Day holiday weekend, when the CPI inflation report came out showing inflation had decreased much more than was expected. Last week I said only a surprisingly big drop in inflation would support rates improving, which is exactly what happened. I was concerned the report could have actually pushed rates higher, so this was a welcome surprise. Okay, so let's take a look at this week's mortgage forecast, and rates should remain lower. This week I expect mortgage rates to hold on to the improvements we saw from last week, the first significant rate improvements I have seen in months. However, markets have proven to be volatile the last few months, so don't count out a return of the higher rates in the near future. Okay, so let's take a look at what's affecting rates this week. Two main factors, economic data and the Fed. So the wholesale inflation data came out on yesterday, and it was actually a little bit lower than they were expecting, so that was good for mortgage rates. Yesterday we saw mortgage rates go lower, and that has been good for the mortgage market and the real estate market too. And then the Fed, this week we should expect commentary from the different Fed members and discussing what they will do with Fed policy. And hopefully the indicators will be that come end of this year and next year that they will not raise the Fed rate as much as they have. And that will be good for mortgage rates and most likely the economy also. All right, so let's take a look at some of the mortgage news for this week. And the big news item that I found was mortgage applications have increased for the first time in 8 weeks, which is good news. That means that there are more buyers who will be prepared to make offers on properties, and this was due to interest rates dropping to lower levels last week, and so there's some good news. Let's hope that will continue and that rates will continue to move down for the next few weeks. Now, one thing I wanted to point out here is that of the new applications, the majority of those are conventional. 75% are conventional, with FHA being 13.5%, and then the VA being 10%, and then USDA being 0.6%. So the majority of our loans are conventional loans. And that might be because the interest rate for FHA and conventional is pretty close. Recently, in the past, FHA could be a little bit lower, but recently I've seen that the FHA rate and the conventional rate have been pretty close, at least for when I'm pricing out buyers who are wanting to get pre-approved. So, but I guess the good news here is that we've seen an increase in mortgage applications because it had been slow there for a while. Okay, so what's my advice for buyers? It's still the same. There are several options out there for our buyers to combat the higher rates. We have a temporary buy down. We have a permanent buy down with points, and they can use seller credits for these options. They must use a seller credit for the temporary buy down. On a permanent buy down, with paying points, they don't have to. They can always put more money down to lower their payments, but that's some of the best options for them. And just this week, lenders have introduced a 3-2-1 buy down, meaning that in the first year it would be 3% lower, and then 2 in the second year, and 1 in the third year, and then in the fourth year their payment goes back up to what they were officially approved at. And if you have questions, your buyers have questions about the buy down, please contact me with questions, and I will be happy to talk to you or your buyer about their particular scenario. So thanks for listening and tuning in this week. Again, if you have questions, reach out to me, Scot Mentzer, Orchard Hill Mortgage, and I'll be more than happy to discuss your mortgage needs or your buyer's mortgage needs. All right, thanks. Bye.